And we're live. Welcome to the pre-summit education series. I am guest hosting today. I'm Zach Storms, one of the founders of Startup TNT. Really happy to be here. Jesse, my colleague, has organized these events. We got three great guests here to have a lively conversation about the state of financing. We're going to get perspective from the bankers, from the venture capitalists, and from the grant experts. It's going to be a lot of fun. We've only got 55 minutes left, so I want to get right to it. To start things off, I would like to give a very warm thank you and shout out to our sponsor for the education series this month, which is our friends at Emily out of Manitoba. You may not know Emily. They're actually a new friend of Startup TNT. Really happy to be expanding our reach across the prairies. Emily is an industry-led nonprofit committed to accelerating Canada's growth as a leader in digital agriculture. So, if any of you are in digital agriculture or in agriculture in general, and you want to learn a little bit more about Emily, I'm going to post emilycanada.com in the chat here. You can check them out. Check out their website. It's EMILI, not to be confused with the famous movie Amelie, but a great name nonetheless. Okay, with that, let's get started. I got three great guests here today. Let's introduce them one by one, learn a little bit about them. Up first, we have Sept, the principal at the Seed Fund and IT Venture Fund from BDC Capital. Also, I'm happy to report, Sept, that you and I both went to McGill University, so I know that we're fast friends. Sept, how you doing?
Good. Thanks for having me. So my background is mostly that I've worked in finance. I started my career working in equity research, and then I jumped at BDC Capital in 2016, and then been with BDC since then. I was a part of the IT Venture Fund. I'm still a part of the IT Venture Fund, through which we invested in a company called Vendasta in Saskatoon that has grown into a massive company now. And then, so we were investing in B2B enterprise SaaS. That was the IT Venture Fund. And recently, I've started working with the BDC's new seed fund that we're working towards. It's an early stage fund where we're going to be making investments into pre-seed, seed, and late seed startups, mostly software. Average check size will range from $250K to $2 million and will lead most of our deals. And then BDC Capital, I'm sure most people here are aware of BDC. It's a Business Development Bank of Canada. It's a crown corporation. So the government of Canada owns it, but it's a crown corporation that is meant to drive return. So it's a profitable crown corporation. And we've got three different arms. We've got a financing arm where we do loans, and loans range from like small loans for small businesses to large loans for large enterprises. Then we've got an advisory division where we provide consulting services. It's a relatively small. And then BDC Capital, that's where I sit in. And BDC Capital is venture capital and private equity. On the venture side, we basically cover most, like if you're a tech startup, you will somehow fit in. There are certain areas where you might not fit in. For example, healthcare. We used to do healthcare. We're not doing healthcare anymore. But otherwise, if you're a women founder, we have got a women in tech fund. It's a $500 million, probably the biggest in the world. If you're a startup in sustainability, clean tech, we've got that too. If you're a startup in software, it's me. We've got a startup in deep tech. We've got a deep tech fund. If you're in industrial, we've got an industrial fund. So, if you have any startup, you've got any company, just reach out and we'll figure out a way to help you through BDC.
If you're a startup, we've got a fund for that at BDC. Love it. Sept, give us a little, paint us a little picture of how active your seed fund plans to be over the next couple of years. Like, how many deals do you think you're going to add to the portfolio?
So my goal with the seed fund, as I was canvassing Canada over the last couple of years, and I went to the BDC leadership as well, and I told them that I think what we're lacking in Canada right now is, one, we're lacking leaders. We're lacking investors who are out there to come and lead seed deals. So that's one gap I'm going to fill, and I'm going to try to do that. The second gap is that we feel like a lot of investors are very geographically focused. So either, they've got a fund that's only focused on the Western Canada, or they've got a fund that's focused on the Atlantic Canada, or they've got a fund that's only focused on Toronto and Ontario or Montreal, Quebec. They're not pan-Canadian truly. There are very few funds that are pan-Canadian, but even those funds, what they do is their most deals are either in Toronto, Ontario or Montreal. So one goal with the new seed fund would be to go out in regions that are, I call them underserved. They're not it's not that there are not enough deals. In fact, I find better deals in those underserved regions, including Saskatchewan, Manitoba, the Western Canada. In fact, I'm in Regina right now at the start of Summit. So I plan on spending more time in those underserved regions, which I call, and I love those underserved regions because I feel, for some reason, I have a feeling that these underserved regions have this chip on the shoulder that we're not, compared to those bigger regions. And for that in mind, I feel like having a chip on the shoulder makes you a successful company. It's such an important thing. So going forward with the new seed fund, we're going to be pan-Canadian and we're going to be very active. The goal is to do probably, I would say, 10 deals per year, 10 to 15 deals. And Dinar and I are two co-founders or two partners of the fund, and I'll be focusing more on the Western Canada and Prairies region.
And is there a sector focus, or are you sector agnostic in terms of the deals?
It's essentially sector agnostic, but software.
Software. Okay. All right. Awesome. Safe. Looking to get to know a little bit more of your perspective on the current climate for raising capital. But let's for now go over to Denise Barrow, an old friend of TNT. She is known as the Grant Sherpa, the Grant Whisperer. She knows all things related to grants, helped many companies access grant funding. She's also invested with us at Start TNT. So she's a big believer in our community. Denise, how you doing? Tell us a little bit more about what you do at Grant Sherpa.
Yeah, thanks, Zach. Yeah, super cool. I'll just tell you some background. So in 2015, there was a change in the marketplace. I'm based out of Calgary, but I work with companies across Canada. But in 2015, we had the first, I call it the crunch in oil and gas. And all businesses, no matter whether you're tied to oil and gas, were leaking money. And we're not getting the opportunities because of and it was an international play that was going on in terms of changing how the economy was spinning. So at that time, I wanted to figure out where the government is going, and that's kind of with how they're spending money, what they're investing in, and that's kind of how I landed in the grant space. And so our goal today is just to kind of help funded startups and scaling companies figure out how they can maximize the grant funding to help them grow and scale. We basically take a look at companies and take a look at the buckets of funding. So there's your capital, there may be investors, there may be banks, and then there's grants. And so what we try to do is help them figure out how to leverage that money based on who they are, where they are, and how to get the money. So one of the things I know to be true is that, there's all kinds of lists out there. There's grants, you can Google whatever you want. But what we find is that really it's a waste for companies to kind of go down that rabbit hole. And so we try to streamline who you are, what you're doing, what sector you're in, and then what's the money that could apply to you along the landscape and roadmap of your company.
All right, well, this is going to be educational for me because we access grants at Startup TNT. So I'm looking to kind of get your perspective on the grant landscape and strategies for a successful grant application. Yeah. So, I'm going to learn along here with everybody else. Yeah. Okay, let's go to our third guest, Chase Christensen, who, he reminds me of why I love Edmonton. He lives in Edmonton. He redefines what it means to be a banker. He's a genuine guy that wants to help entrepreneurs access capital. He's also approachable. And, he's the type of person that you might run into at your daughter's music concert in your neighborhood. You're not really sure why. It's like, why is my banker at my daughter's music venue? That's the type of city we live in, Chase. That's the type of guy Chase is. Chase, how you doing? Thanks for joining us.
Oh, doing well. That was certainly a fun Friday night. I appreciate you not asking too many questions while I was there, considering I don't have kids. That's the puzzling question, right?
No, anyways, but seriously, Chase, tell us a little bit about your role at RBC and RBC's kind of approach to startups.
Yeah, absolutely. So my role with RBC, I'll give a little bit of a background on myself and how I really got to where we're at right now. I think a lot of people are going to be familiar with RBC, but RBCx, that fourth letter, probably throws a lot of people for a bit of a loop in terms of how does that differ from the broader bank. So my career, and don't hold this against me, I've been a career banker, came straight out of university, went into banking at a separate bank, joined RBC specifically with the opportunity to work with the tech sector. Because as a banker, you always want to work with companies that are doing the most interesting things, that are growing the fastest, that are solving the best problems. And I figured what better industry across the prairies to work in than tech, if that's the focus. And so joined RBC about 5 years ago, which feels pretty crazy to say, and specifically within the RBCx team since we've launched it. But so RBCx differs quite a bit from the broader bank, as we are really focused on specifically the technology industry across Canada, technology and life sciences. So we're not going to be working with the oil and gas company down the highway in Calgary. We're not going to be working with the machine shop out in Niski. We're going to be only focused on technology end to end. And so from our perspective, that's really those companies that are at that cutting edge, that are doing the research themselves, that are investing money heavily into research and development, that are taking advantage of grants that are out there to fund their progress and their research, but that are attacking a big problem. And so with that, we know that it's not just the capital side of it. So we've really built RBCx from the ground up to really support the platform and to support technology companies end to end. So not just saying, hey, when you've got to that level of commercialization, you can show a profit, great. When every other bank's going to love you, we love you. We want to say we'll love you earlier on. We'll help you solve those problems. We'll kind of come in. I mean, we work with clients that are incorporated the day that they start working with us. So really supporting them across that entire life journey.
All right. Thank you, Chase. So let's get to it, guys. Let's start a little bit with like the current climate for fundraising, across venture capital, banking, and the grant ecosystem. And actually, I was reading a report recently from PitchBook. They release great reports on a regular basis, and I thought I would just share this graph just so we can all see what's happened in the last couple of years. So, Saf, I'm going to maybe point this question kind of towards you to help you maybe help us interpret this. But you can see like we had this massive peak. This is specifically angel and seed deals from the PitchBook data. So this is US data, but I know the trend is kind of similar in Canada right now. We had this massive peak, and this was a global trend in late 2021, early 2022. Lots of deal activity happening, and you can see it's dropped off quite significantly on a quarterly basis. What's happening? How is this impacting the current climate for raising capital right now? These global trends. Saf, what do you make of this?
Well, so this is a good data, and I think when I look at Canada and the US, one thing I also do here is that a lot of times what happens is like you classify seed as anyone saying that we're raising a seed round, okay? However, there are a lot of early stage companies that are raising massive seed rounds, and what it does is that it skews this number, and that's what we were seeing in Canada as well. So, for example, last year I remember I was looking at the data. There were like company that raised is $30 million seed round. In fact, this year I know a company. In fact, it's public. Passage. It's the Apply Board's co-founder who started his second company. There is a $40 million seed round. So that to me is not a typical seed. So I think when I look at the data, I take out these numbers, these deals that are actually skewing the number. And when you look at that, the picture you're showing is actually probably a little bit more. It's a bit less actually than that. So yes, it's true. The market is difficult. It's a difficult time to raise capital, but I'll go one by one on the different stages, right? So the late stage is extremely tough right now. And the reason is that because late stage investors, they have a investment time horizon of like 3 to 4 years. And the way they're exiting is mostly through IPOs. Right now, the IPO market has completely dried down. So therefore, the late stage deals, if you're a late stage company and if you're out there in the market doing a deal, it's really tough. Either you do not raise and cut down significantly on your cost and just be EBITDA positive, cash flow positive, and survive the next few years. That's the advice most of the late stage companies are getting from their investors. So that's one. Or if you really, really need cash, you're going out and raising capital, and you're raising capital at significantly lower valuation than your last round. So as an example, Instacart is going public right now, 76% below their last valuation. It's a significant down round. Similarly, Stripe, 6 months ago, raised a round at 45 billion, which is half the valuation they had in their last round before that. So late stage companies are really suffering raising capital. So that's the late stage dynamic. Now let's go to the Series A and B. The challenge at Series A and B right now is that the scrutiny or when you're as an investor, you're assessing these Series A and B companies, you're looking more at unit economics. You're not just looking at, okay, give me growth for any reason, which was the case around the pandemic or even before the pandemic. Now it's like, show me a path to profitability. Now, for a lot of these tech companies at Series A and B, that's a new phenomena because what they were doing before is like spend, acquire customer, grow at any cost kind of a thing. But now it's more like, yes, grow, but sustainably. Show me rule of 40, but show me rule of 40 with better EBITDA margin rather than higher growth rate. So the rule of 40 idea of rule of 40 has also changed. And then you come to the seed. I actually believe seed is sort of business as usual in a sense that, yes, the amount of capital going into the ecosystem, as you can see with this chart, and Canada as well, has gone down. But if you're a good seed company and you're out there raising, the terms are still the same. As you know, Series A and B and late stage, as I mentioned, the terms have changed. But in seed, the terms are somewhat the similar. Like the valuations at seed are mostly not based on metrics. It's based on whether you're a first-time founder, second-time founder, what kind of problem you're solving, what's the market size, and all that. So the valuations around seed are somewhat the same. We are not seeing any punitive terms. For example, we used to see participating preferred share class back in the 2000 or even later when the times were bad. We're not seeing that at all. But yes, definitely the market is down. There's less. But overall, as interest rates have gone up, there's a lot of pressure from LPs on the VCs who they've got the money from to be like, okay, interest rates are high. You've got to give us higher return, otherwise it doesn't make sense. And that's why there's a lot of pressure on the deals the VCs are doing, which is that you need to find a really good deal, and it has to be solid.
Yeah. All right. That's some great insight, Saf. And maybe there's one other interpretation of this is like, while the numbers look bad compared to say 1 year ago, they actually look kind of similar to what they were relatively recently 3 years ago. So it's not really that bad. Although I realize there's more companies in the ecosystem now. Okay. You could have mentioned there some shifting in strategies and what VCs are now looking for at the Series A, B stage. Do you think that those, maybe it's too soon to answer this, but do you think that those are shifts that are going to be long lasting? And this is something entrepreneurs should be thinking about now when they're building their company. They need to be able to demonstrate, the path to profitability rather than simply the path to growth sooner.
It's hard to say. Honestly, our memory is very short term. So if you think about the pandemic, how things were and now things are, it's so interesting that how things have changed so quickly. And at the same time, the reality is that we do not look at history as much. We should look at history a lot more than we normally do. So in 2000, around the same time we had the internet boom and all that, same thing happened. We saw a huge spike and then boom. So in short term, what I've seen from history is that we always overestimate. So I feel like that's what's happening right now. This is a very short-term thing where we're overestimating a little bit, and eventually things, I believe, are gonna come back to what we feel like was the more normal. But having said that, all in all, I think this is good. This is a good correction in the ecosystem where now people are now focusing on more on metrics, business model, like the fundamentals. I think we shifted a little bit from fundamentals to FOMO. There was a lot of FOMO investing over the last couple of years. So it's good that we're getting those FOMO investors out and more investing out and actually more focused on fundamentals. It will stick around for a bit, I think.
Yeah. Okay. Well, listen, thanks so much, Saf. Let's go to Denise. Let's talk about the current grant landscape. Has that evolved over the last couple of years? What is that?
Yeah. One of the things interesting, Zach, in terms of grants is a lot of people woke up to leveraging grant funding when COVID hit. So my phone doubled, the phone calls doubled for me when COVID hit, because everyone who I talked to and said, hey, you can get a grant for that. They're like, we might as well just do it ourselves and blah, blah, blah. And then it's like, okay, now we're paying attention because we want to figure out how we can maximize these dollars. If we're taxpayers, we want to, capture that money. So it kind of woke people up to, their model of how they're building their business and how they're building their companies and going global and actually maximizing the resources. So, one of the things that's always stable. So even when we talk about maybe the downturns in the market, it's actually a time when the government reinvests in grants because they want to stimulate the economy. And that's what grants are meant to do. So things like jobs, like job creation, the grants are continuing to flow. And research and development. So one of the new things on the landscape is the new Elevate IP program that's happening to support companies, because one of the ways the government competes globally with countries like China and the US is who has the better selection of IP growing, because they know that that's an indicator of future economic growth. So our federal government just invested in helping startups capture money to develop, number one, they have to develop a strategy, not just apply for IP for some aspect of the business, because the government wants to make sure people are well planned and know all the different aspects of their intellectual property, as an example, before they go to implement. So a lot of programs, hiring grants, R&D is huge, right? That's probably one of the biggest ways the government invests. And then it also depends on the regional things that are going on. So each province may also have trends happening and markets that they want to stimulate. So yeah, there's a lot of opportunity in the grant space to help companies grow and scale.
Yeah, awesome, Denise. I know anecdotally for me, I kind of fit exactly the story you just described. Got really excited about the granting landscape when COVID hit. Grants were, I think, easier to get too. Like there was everybody was trying to act quickly, and there was more grants available.
Yeah.
So, do you have any data on, like, is the overall grant pool shrinking?
Well, yeah, it is. Well, it is. So a couple things that have happened is competition has increased. So the quality of your applications has to be there, right? And how you're applying, it's not just filling in a form. It's really about paying attention to the metrics and what that funder and the process of what they're looking for from you. The other thing is in the grant landscape is what happened before COVID is we could apply for a grant and find out in 2 weeks. And now sometimes you'll apply for a grant, you may not hear for a couple months, right? In terms of the speed of how it's done. And then the flow of money, where the money's going. So every April 1st, the federal government launches their plan and budget where they're spending. And this year it was a particular emphasis on clean technology and environment. And so this year, all the money is flowing to those companies. Even some of the traditional hiring grants are not available. They're available if you're an environmental position and an environmental company. So it impacts everybody else in this spectrum as well. Yeah.
I wonder if the number of clean tech companies, or the number of companies that suddenly realized they were clean tech companies, miraculously increased.
Yeah, they're integrating how they're clean tech now. They're adding an element.
All right,
and then the other, just one other thing that I just want to add is the other aspects of things that are important to think about is the government in a couple of years ago started looking at making sure that they were funding diverse companies, right? So in most of the applications and grants now, there's a quota of money that goes to each of these companies, each company group, right? So they're asking you, are you a visible minority? Are you LGBTQ? Are you a woman business owner? Are you a visible minority? Because they actually have to make sure that they're allocating money to those different groups as well. So that's a new element that started in probably 2019, 2020.
Okay, well, for those that fit those groups, use that to your advantage for sure.
Absolutely.
Okay, let's talk to Chase a little bit about how all of the current climate's impacting the banking sector, and maybe kind of like the strategies banking's been using. Everyone thinks of bankers, Chase, as very risk averse people in suits. Well, you got the X behind RBC in your department. Tell us a little bit more about how the current landscape structured your strategy recently.
Yeah, absolutely. And I mean, so if we're talking about from the financing perspective, I can speak from RBCx's perspective, but I think when you see in the market, there's a little bit of I think banks in this sector have been in the market or been in the news a lot over the last year. Where we see that, and I think the biggest takeaway that I'd want everybody to have here is, with everything that's been in the market or in the news on banks lending to technology companies, none of that's been issues with the technology companies themselves, with the companies, with the industry. And so from our perspective, when we look at that, our risk appetite is still the same as it was a year ago, the same as it was 2 years ago. Likely, I would probably say it's fair to say it's increased as we continue to develop our offerings for technology companies. We've always taken a longer term approach to the industry. We're not looking at winning just in 2023, 2024. We're looking at how do you build something sustainable in terms of guidelines, in terms of lending programs. We know that changes, right? When we look at how things have evolved over the last 2 years, I'd say over the last year, even with capital being a little bit harder to get, say in later stage companies, we've seen our offering actually get stronger, largely driven by market dynamics. We've seen, say, when we launched venture debt in 2022, we've now increased the terms. We've increased the dollar amount that we'll put out dollar for dollar based on what the demands in the market are, based on what clients need, on what companies need. And so really from our perspective, as long as we're taking that long-term approach, short-term storms, if we've seen, a reversion to the mean in terms of venture capital dollars, or with the new normal, if this is temporary or permanent, it's not changing the way we're looking at the market. We still continue to see, I can speak internally, a number of proposals going out Series A, B companies across Western Canada. That hasn't changed. The velocity on those is pretty consistent how it's been. What I'd say is we probably have seen a greater trend in terms of companies coming to us to have that safety net, where historically maybe the capital was being requested because people were going out and doing inorganic acquisitions. They wanted to fund their M&A strategy. They wanted to grow the top line of the business. Now it's more to say, hey, if we were looking on an 18-month horizon from Series A to Series B, maybe now we're looking 24, 30, 36 months. So we want that additional capital to shore that up, to make sure that we don't need to make any drastic choices, or that we can use this now as that lever to get to profitability. So we're seeing that. In some of the earlier stages, I'd say the difficulty lies is that because you mentioned risk averse, we've had a pretty conservative mentality on this. We aren't out there buying every deal or doing every deal. Is we're seeing there still being a lot of opportunities that the banks aren't funding, but that gives a strong opportunity where it leverages the greater ecosystem in Canada. I think in Canada, we have a really strong network of lenders that are there to support companies where perhaps banks aren't there. BDC has a phenomenal practice in that sector from the bank side and the lending side, where I know friends of TNT, Jean-Luc and their BDC tech team are phenomenal in that space, but as well as some of the tech companies in Canada that are specifically focused on that space can also shore up some of the areas where it's not within our mandate. So if it's earlier stage company, if it's, say you're looking for $100,000 to do shred lending, we can step in. Also going to be scenarios where we can't step in to do that. So it continues to remain a conversation. Obviously, now interest rates, Bank of Canada rates being a little bit higher makes the debt conversation a little bit more painful, but it still remains a pretty ready access to capital for the right types of company.
Is your overall loan volume now similar to what it was a couple of years ago, or has it changed?
So I'd say it's still larger because when we look at that, a lot of our lending is going to be based on the evolution of the market as clients progress along that journey, going from seed, Series A and beyond. That's really where our lending appetite lies at the moment. We're still seeing there to be a strong appetite there. We've put out more term sheets than we have in the past. We continue to deploy capital. Where I'd see is a trend, and I know it's not exclusive to us, is where some of these facilities maybe a year ago may have been undrawn. People are starting to use them a little bit more. They're actually starting to draw on that capital rather than having it purely in the back end.
Are you seeing stiffer competition for the loans at RBC? I know both Denise and Sept kind of mentioned that, the competition for the grants and the venture capital is a little bit stiffer now. Is it similar in banking?
Yeah, absolutely. So I would say, because especially if anybody watches the unique subsector of news that comes out around banking hires, nobody on the call, other than maybe my colleague Rohan and I probably do, is you'll see a lot of the large banks in Canada have actually started to bring on board a lot of tech lenders, a lot of experienced tech lenders to start building out their focus. So where I'd say we see a lot of competition where, obviously some of our competition is changed over the last year. We're starting to see a lot of the traditional players in the space open their eyes to the opportunity and the incredible industry that is technology in Canada. So I'd say we're going to see a stiffening of competition, which is ultimately great for who we all serve at the end of the day, which is the technology companies themselves and the founders. So we absolutely are seeing that stiffening of competition, but it pushes us all forwards, which is fantastic to see.
Well, guys, let's chat a little bit about, pathways and strategies for securing financing. Because I think we've kind of established that it's not as easy as it was a few short years ago. We got to be a little more vigilant. We got to think a little bit harder about our strategies. So Chase, let's just keep the conversation going here. Tell us a little bit about, how you guys work with clients to figure out between banking, granting, and venture capital, how to help them kind of arrive at a strategy.
Absolutely. So, the way that we always look to do it isn't going to be focused on a specific product or specific loan. It's very much that relationship-based approach where we want to focus on discovery. We want to dive deep. We want to understand what the challenges, what the opportunities are facing the client in the next 6 months, 12 months, a few years, so that we can try to opine on where we see there being a good opportunity. Often that means that if we can't take a direct financing approach up front, we can lay that foundation to say, hey, let's work with some partners in this front. If it's, let's raise capital right now, let's start that process to raise capital, which I think everybody is seeing takes longer than perhaps it has if they think it's historically taken 6 months. It's not going to take you 6 months anymore to close a round. And so it's working early on to say, let's lay this out, because I mean, the better that our clients know when we're able to step in or when our partners are able to step in. So if that's BDC, if that's Export Development Canada stepping in to augment a solution, we can lay that foundation so that it's no surprise to say 12 months from now, you hit these goals and these objectives. Absolutely. It makes it easy for us. And so in a lot of those scenarios, we want to start that conversation very early so that as individuals are going through the capital planning process, we can have a seat at the table and really bring partners to the table, because we know that it's not just going to be us. We want to try to act as connectors. There's going to be some examples that we would love to share. And I mean, I think it's probably no surprise for privacy for any of those success stories where we have managed to deploy capital. I can't share specific names. What I can say is on our website, and I can share the link with you, Zach, if you want to drop it in the chat, but we have a number of client profiles across Canada of some clients where you can read between the lines and you can see some of those scenarios where we help them along their journey. So we can't name the names. Our website can name the names where it's public, of where we've actually been able to deploy some of those solutions for clients and how it's managed to support their business.
Okay, awesome. Thanks, Chase. All right, Sept, I'd love to maybe get your perspective on this. You kind of hinted a little bit at this in our earlier conversation about, kind of reverting to like core fundamentals for raising capital. So let's just talk about those. Like, what's your advice to startups here that if you're thinking about doing a pre-seed or seed round to think about as they approach it in the current climate?
So if you're a seed startup, I think what you got to focus on is a little bit more on the problem you're trying to solve. I think a lot of the question goes back to the fundamental, which is like, what problem are you really solving? And the solution you have, is it unique or not? I think if you have a problem that's important enough that there's a huge market for that, and you're unique enough that you have a competitive advantage, some sort of a competitive advantage. It could be technological. It could be that you're faster. It could be you're cheaper. Maybe cheaper is a tricky one because you have to be like maybe 5x cheaper or something, like, because you can't be just marginally cheaper. If you're cheaper, it has to be, you need to have a competitive advantage. And if you have that, along with a solid team, which has got a domain expertise, you've got a background that you have either lived the problem yourself, or you have seen the problem firsthand, or you were a part of the problem in some ways, and then you're just trying to solve that. I think there is still, a funding out there for you to be able to go and convince a VC to be able to invest in. So yes, but at the other side, I think it's tricky in a sense that the seed, it's all about the team. It's all about the market. It's so much art than science. So there's no metric or anything that I can give you, be able to like, okay, you got to do this. It has to be very much like artistic, like, okay, am I really solving an important problem here? Does it really, really matter or not? And is the solution unique enough or not? And if you really get a good answer to that, I think that's important at the seed stage.
Yeah. Okay. Great way to think about it, Sept. Let me follow up with a couple of like questions on like how the current climate might be manifesting in the entrepreneur's experience. For example, is due diligence more intense and taking longer right now, or is it similar to what it's always been?
Due diligence is definitely taking longer. And this is only because that, there's just like not enough VCs actively investing as they were before. As I said, there was a lot more flow of money into the market. So there's a little bit, pulled back in that sense. So yes, due diligence is taking longer. There's a lot more question around, as I said, those things like there's a competitive advantage and whatnot. Before, I saw companies raise like $2 million plus in Toronto within a matter of few weeks around the pandemic. And now, similar kind of companies are struggling to raise $1 million even. So yes, it's taking time. It's becoming a bit more difficult for sure. Yes.
Yeah, okay. So like it's hard to raise capital. It's taking longer. Is it impacting valuations that you're seeing, Seth?
Seed stage, no. Seed stage, the valuations are somewhat the same. Maybe a little bit difference, a little bit more. There's a little bit more power on the VC side where you're like having terms that are more investor friendly, but overall the valuations are somewhat the same. And I'll give you a ballpark idea. I think when we look at valuation for a pre-seed company, you're still seeing that the 4 million, the $3 million for a pre-seed first time or second time founder more like 5 million. We're still seeing the same thing. And then as you are kind of raising a pre-seed where you don't have revenue to show or whatever, I think what people are asking for a lot more is like, do you have pilots? So before you'd be like, yeah, you're a pre-revenue. There you go. That's fine. I believe in you. I think you're solid. You've got domain expertise. Now I'm asking, can you show me a few pilots? Can you show me some sort of product market fit that I can see? So that's happening. And then also at seed stage, a lot more of due diligence around customer calls. So we're looking at a lot more of that too. Is like, have you done some customer discovery? Can you show me videos? So I've been telling this to founders recently that if you're doing customer discovery, record them and record all of them, good or bad, and then give it to your investors so that they can actually look at it as well. And that's very helpful for the founder as well and for the investors too.
Oh, okay. Okay, I want to remind people, if any of this is like making questions go off in your head, feel free you should be able to add them in the chat. And we can take questions as we go here as well. If you guys have any specific things you want to hear about.
I have a question for Chase, if I
Go
can.
ahead.
Yeah. So Chase, when we look at, I think a lot of people in Canada were wondering around the SVB collapse, right? I mean, I think it's good to remind people of like how the venture debt market is different in the US versus Canada, and how come we still were able to come out of it without significant impact, right? If anything, correct me if I'm wrong, I saw RBC doubling down after the SVB collapse and other banks actually entering the market. So tell us a bit about how did you guys think about that?
Yeah, absolutely. And so, I mean, this is where, when I mentioned earlier with SVB, everything there, I mean, we don't want to get into it too much, but it wasn't a failure of the economics with venture debt, right? That wasn't what the underlying cause was, because the premise behind it is still sound. When we look at it from our practice in Canada, because I mean, what you'll see is a few different banks will have different definitions of what venture debt is, but at times it can be a little bit just semantic to determine between them. But really, when we look at it, it's lending to strong companies that have a strong growth mandate behind them, that have largely, and a lot of our due diligence is based on backing the investors themselves. So as long as there's great investors coming in, venture debt is a great product because it provides that growth capital. Where we've seen it is, I think Canada has historically had a bit more of a conservative approach to it, whereas venture debt hasn't been around for nearly as long in Canada as it has been in the US. We launched our practice there. We're effectively at our 2-year anniversary on when we launched venture debt. And so I think a lot of the banks, as we're getting into it, because I would say CIBC and RBCx were the two that have been doing it longest in Canada, have historically taken a bit more of a conservative approach, where it's not going out there and bidding on every deal and pushing to win every deal at the absolute top of the market. It's about doing things that are sustainable, that make sense for both the business, so not over encumber a business, but then also that makes sense for the practice, so that when we look at it 2 years down the road or 5 years down the road, it's still a strong book of business. And I mean, even with SVB, as evidence, National Bank bought the book of business. So the underlying economics of that business makes sense. So we're still seeing that. It's that sustainable approach that's really led us to be able to double down on it. And really, from there, it's allowed us to shift our strategy even. I mean, recently we've welcomed a couple new team members on to the RBCx team, specifically senior leaders that have had experience at Silicon Valley Bank, that have had experience at what would have been our competitors in the market. And we know that's going to just strengthen our offering in a very sustainable way. Hope that answers the question for you there.
Absolutely. Sounds like a classic Canadian story. banking sector is just not quite as aggressive and risk-taking as the American one, and then weathers the storm quite well.
Absolutely.
All right, listen, let's, we got a question in the audience here for Saf, and then let's go to Denise. So Saf, I don't know if you can see this question. I'll just repeat it for everybody. What size rounds are you typically seeing right now for pre-seed and seed rounds, where the software company has an MVP and maybe a low six-figure ARR? This kind of sounds like a typical stage you would see a company doing a seed round. Has this increased, decreased over the last couple of years? You want to elaborate? You kind of touched on this a little bit. You want to elaborate for us?
Yeah, so in Canada, this is, I mean, I think it's in the US as well, is that we see that the round sizes, especially at seed, they vary with geography. So if you are in the Western Canada, the round sizes are different. If you're in Toronto, the round sizes are very different. Montreal, similar to Toronto, but if you're in Prairie region, like Saskatchewan, the round sizes are very different. So what I'm seeing mostly is that the the metrics that were mentioned on the chat around that is like 1 million, 1.5 million is typical round size. And then if you are in Toronto, so then you are going more like 2 to 3 million for the same round size, for the same kind of metrics. And overall, I think generally they have decreased, yes, but they haven't decreased significantly. I think they have decreased, but we are still seeing, as I mentioned, we saw a second-time founder raising a $40 million seed round. So we are still seeing significant larger seed rounds, but yeah, you gotta you gotta be either in like the geography. Unfortunately, matters.
Yeah, and I mean, honestly, and people often talk about this, but people have to remember that like the cost of building your startup in certain geographies is just straight up cheaper than it is in other geographies. So there's kind of good reason for things not to cost the same. Sept, did you want to add any other color to like why the geography matters in terms of like maybe your valuation and overall round size?
So the geography, absolutely, you're right. I mean, the cost of hiring and all that. But having said that, I think the remote hiring remote workers have kind of improved that a little bit of it. But I think more importantly, what's happening is, as I mentioned before, is that we've got these regional investors who are just focused on one region, which is great for that region. But what it does is that the other region investors, for example, investors from Toronto region are not coming enough to prairies, right? And they're not. So there's just simple demand and supply. There's like lack of supply, but there's huge demand. What ends up happening is you have smaller round sizes. That's it.
Sure.
Whereas in Toronto,
so it's a bit of an economics issue too. Okay.
It's just like everybody wants to be in Toronto because like everybody wants to be in the Bay Area. That's why the round sizes there are even bigger, because demand and supply, same thing.
Yeah. Okay. Awesome. Great way to think about it. And Denise, you kind of mentioned that in the grant landscape, there's a lot more demand right now than there is for supply. So let's talk a little bit about, practically speaking, how should founders be thinking about approaching a grant?
Yeah, first of all, I think one of the things, well, just to touch on to your comments, say about the funding landscape. So I get calls sometimes from investors in the US who want to set up in Canada, and they'll say to me, we're thinking about Toronto or Vancouver. What do you think? Where's the opportunities from a funding perspective? And I'll say, well, let me educate you about where the money is and how you can get the best money. And if you're hiring staff, where are you going to get the talent, right? And then the cost of living for those people to build that business in Canada. So we talk about, I'm always educating international investors who are coming to Canada and saying, hey, we think Toronto or Vancouver is the place. Is that really where we should be? And it really depends. And I talk about what each province brings to the market and where their expertise lies, and the talent that they can draw on, because that's another part of it. But that's just a side note. So just in terms of Zach, in terms of the funding, one of the things I think it's really important is for people that are applying for funding, understanding what the funding is meant to achieve. So the government invests in things to impact the economy. So understanding when you're applying for funding, like for example, R&D, research and development, it's transformative. What they want to see is, do you have innovation? And how do you prove innovation is through, can you capture IP for that? So a lot of the things you have to understand what's the recipe behind it. The key thing to keep in mind is, where do you fit in the pain point of our economy? Like really tying your company to what are the pain points and how you're going to actually make an impact on the economy is another thing that's really important. And then the other piece that's kind of contrary to angel investors, I've heard them saying things like business plans are not worth paper they're written on. and things like that in terms of the landscape of don't waste your time there. However, when you are applying for grants under 50,000, you're typically good with a lean canvas. When you're applying for any money over 50,000, it's a requirement to have a business plan. So one of the challenges I see with founders who are trying to build their business is they come to us and say, hey, Denise, we want to apply for Prairies Canada. We want to apply for Alberta Innovates Clean Technology Fund. Blah, blah. And I'll say, okay, here's the docs you need. And they'll go, oh, we don't have that. Do we need it? yeah, you do. So I always encourage people to kind of find out, what do we need? If we're going to go forward in our landscape, what do we need? And business plan is kind of a core document. And how the government uses it is that they're taking a look at your application and the content, and then they're checking back with your business plan to see if it aligns, right? Another thing that's really important is if you are working with investors or you have been invested in, let the government know, because if an investor has done their due diligence, it makes it easier for you and less work for them to do their due diligence if they know someone's already put that work into place. So always mention those partners that you've been working with, whether it's a bank, whether it's investors that have done some of that work in advance.
Denise, what about building a relationship with the funding body itself? Like, how important is that?
It's paramount. So sometimes, I'm not going to talk about specific organizations, but sometimes what you may not know about a funder is they may be the decision maker for a bucket of funding that they get every year, and they're not telling you that, but they're going to be a decision maker. So they have to know, like, and trust you in order for them to invest in you. And it's like no soup for you if you don't fit the criteria, if you don't build that relationship. Because again, you got to think about these funders, and some of it is subjective, right? Some of this funding can be subjective, but it's based on the experience of some of these advisors who have gone down this road for years and years, right? And they know what works and what doesn't work. So what they're trying to vet out is this, they're spending taxpayers' money as well, right? So that's something we got to think about. They're risk averse. They don't want to, willy-nilly on somebody who's not planned and has too much risk on their plate. They don't have the right people on their team in order to drive this forward. They don't have their own capital to invest. So that's another thing, Zach, is that companies have to have capital to match the government grants. Grants aren't just free money that they just give your company upfront to do it. You have to show that you have money to match their money. And that's another way that they de-risk, are you ready? And that you're planned in your approach. Even if you have new technology, you still need to say, hey, we've got this new technology. This is the market we're going to serve. We know that the total addressable market. We know the serviceable market we're going after. We know how to reach our customers. Like, they still want all of that, even if it's new technology.
All right. Thanks, Denise. Okay, we got about 10 minutes left. I want to address this question, which I think is an important one. We get it a lot, not always framed this way, but Jade from Glitch Secure has a follow-up question, which says, any hot tips for those of us in Manitoba and Saskatchewan, which we can generalize that to any hot tips for getting you in front of the investors. Probably the most common question I ask is, how do I get in front of investors? They're not returning my emails, they're not returning my phone calls. Sept, maybe I'll hand it to you to go first. How do you get recognized by the investors in this journey?
I think one good way, as you mentioned, start a TNT or any of the other accelerators. I know Connexus does a lot of work. Collabs, all those guys. I think it's very important to be a part of them, and kind of through that, that's a good source of deals for us as well. So we kind of are close to all of these guys. So that's one. Two, conferences still a good mean of like meeting investors. I'm here at Startup Summit at Regina. I was at Uniting the Prairies a couple of months back. I was at the Startup Fest in Montreal, Toronto Collision. So specifically for this region, I would say that if you can find an organization like Startup TNT or an investor who's got relationships outside of the Prairies region and can get you in front of an investor in maybe, let's say, the Vancouver or Toronto or Montreal, I think that will make a lot of difference. I think I am trying a lot more to come to this region. I think not a lot of investors from the Toronto, Vancouver, that region come here. So I think a lot more of that effort needs to be done on our end. So it's more on the VC's end. But while they're not doing that, I think as a founder or a founder of a company, you can potentially get out there. And if you do that, and when you get a Toronto or a Vancouver VC, the next stage from there is that once you pick a VC outside of this region, is like ask them, how can you put me in front of a US investor? Because what we have seen from our data is that once a company gets out of the region and get an investor out of the region, they actually scale really fast. There are so many examples for that. One example I can think of top of my head is Milk Movement. Again, another one is Verifin from Halifax. Same thing, right? You got investors outside the region. There you go. Boom. Vendasta, great example again. Same thing. So try to focus on investors outside, like regional investors in the early stage. Pick one and see how can they help you get out of the region.
Yeah. Okay. Great advice, Saf. Okay, we've only got a couple minutes left. Let's spend at least a couple minutes here thinking to the future. So looking at the advancements in technologies, changes in our like macroeconomic conditions, changes to what's going on in the world at large, where do you guys see the future of startup financing headed over the next 5 to 10 years? Anybody want to make some predictions here?
Well,
Denise,
sure. I'll speak about some of the key things that I see. So recently, some of the federal government focuses has been protecting our borders in the north. So there's all these challenges that have been happening recently about, can you set up houses that are sustainable in the north? Can you set up bridges? How do you do this? How do you do that? And so there's a lot of work going around protecting our borders. Cybersecurity is another one that I think it's going to be an everyday word, and every company, everyone will have just a cybersecurity strategy that they don't have now. And automation of things. Water, our water resources are going to be water wars in the future, and I think that's going to be a big area. And then anything sustainable, because as our world with all the fires, we can't afford the insurance costs, we can't afford the staff that we're putting towards all these environmental disasters. So we're going to have to come up with ways of being more sustainable in our world, and that's where I think the funding will fuel.
Okay. Thank you, Denise.
Yeah,
I
would agree with that. Specifically, I mean, really emphasizing the sustainability side of it in the green. I mean, we see a lot of that beginning, I'd say at the high end in capital markets, in large corporate worlds. I think we're going to start to see that trickle down quite a bit more in sustainable finance as everybody shifts towards their ESG goals, right? If it's scope 1, 2, 3 emissions, if it's even with Apple yesterday having zero or carbon neutral products, I think there's going to be a lot more emphasis on that moving forward. I know one of the trends that we're seeing internally is at least specialization in certain industries. So knowing that, hey, you look at life sciences is a sector in Canada that if you're in certain areas is talked about a lot. If you're not in those areas, you don't hear much about it. There's a lot of specialization that needs to happen in there because there's a lot of challenges from both the investing and the lending side. And so I think we're going to start to see a lot more of a trend there. If you look at the personal side, there's a lot of the fintechs that are coming up. And I know it's a lot of the banks are quickly figuring out how we partner with a lot of these fintechs across Canada, because I think that's a massively changing landscape. Even in the investment world, you see a lot of more crowdsourced investments, AngelList, you see companies like that. So I think there's going to be some trends there, but I'd say from a banking side, it's tough to predict specifically within our world, as banks generally aren't the quickest moving thing. We try to move a little bit faster, but generally not the first at the start line there.
Okay, let others figure it out, go through the trials and tribulations, then adopt what's working. I hear you. It's smart. That's smart. Okay, Saf, final word. What's the future of financing look like for us?
In terms of industry, I think we've seen a lot of AI, so I'm not going to talk about it. But I think one thing which I found interesting was that what pandemic did to us was it accelerated the technology adoption, basically. People who were not essentially doing e-commerce before the pandemic, or most of them are now buying online. Same thing with deliveries and whatnot. So the technological adoption has significantly increased. If anything, if we were to be in this technological adoption space as we are right now, we were maybe supposed to be in 2027, 2028. We're actually right now in 2023 in terms of like using Zoom and all that kind of stuff. So that has significantly picked up. If you keep that in mind now, there are certain sectors where we were hoping there will be technological adoption over the last decade, and it wasn't as good. For example, prop tech, right? There was, but there wasn't like, oh my God, significantly changed. There was still some sort of pushback, right? Same in agriculture, ag tech. There was a technological adoption, but not as we were hoping for. But now, since after the pandemic, what I'm starting to see is that there's a little bit significantly. That has changed. That has changed the mindset. People are like, oh my God, now it's so easy to use this. Okay, I can see myself using. So we are seeing that the prop tech companies are now really disrupting. So my big bet right now is prop tech is going to be, over the next 5 years, we're going to see a lot of significant adoption around that.
Yeah. Okay. Cool. Listen, guys, it's just about over here. We're just about out of time. I just want to give one big final thank you to all of our guest speakers. Denise, thanks so much for coming. Just to reiterate, Denise, Grant Sherpa, one of our region's foremost experts in strategizing around how to get a grant. One of our TNT investors. Great to have you around the table, Denise. Chase Christensen and RBC have been a sponsor of Startup TNT for a few years now. Thanks for joining the panel. Thanks for being part of the community. Hope to see you at the pitch night, Chase, in a couple of weeks. And Sept, BDC has actually been one of our sponsors since, I think, 2021. This is the very early days. So you're a big organization. You got lots of different parts. Great to have many different members of the organization join us for these types of things. I love these sessions because I learn a lot. I hope you guys did too. Enjoy the rest of your day. And applications are due Monday. And one final point, there is an option on that application to click a little box that says, would you like us to share your application with investors in our network, which we do. So if you're looking to get in front of more eyes from outside your local region, we're working on helping you do that as well at Startup TNT. Thanks, everybody. Have a great rest of your week. And tonight's Thursday. So go have some fun, make some friends, and build companies across the prairies tonight. See you, everybody.
Thanks, Zach.
Thank you.
Thank you.